So reading number 34 of the curriculum will take us through another important process in the valuation of a company, that is the process of industry and company analysis. Now, in a bottom-up analysis, we start with individual companies and individual segments of the company, see the performance of each segments and aggregate them across the company to get to the total growth of the company, and then aggregate across companies to get to the growth of the industry. So we start from one segment or one company and work our way up to calculate the return on the economy and the return on the industry. In a top-down analysis, we start with macro expectations. For example, the GDP growth rate, the inflation trends, etc., and then try to see how that will affect different industries and what impact they will have on the companies, and try to derive the growth of companies using a top-down approach. A hybrid approach combines elements of both the top-down as well as the bottom-up methods so as to arrive at the industry profitability, growth rate and the valuation. Now, when analyzing our industry or analyzing our company, the process of valuation requires us to first estimate the cash flows and then discount the cash flows back to derive a value for the company. In forecasting the cash flows, the first step almost invariably is to forecast the revenue. Now, there are two broad approaches suggested in forecasting the revenue. First says calculate the GDP growth or understand the GDP growth from the forecasts of economists or various market participants, and then see how your company will grow relative to the GDP growth. So we can do a historical regression and try to see that when the GDP grows 5%, the company normally grows 8%, or when the GDP grows 10%, the company normally grows so much percent. So in the growth relative to GDP growth approach, we first estimate the relationship between the GDP growth and the company sales, and then the company sales growth is forecasted based on the estimate of future GDP growth. So in the future, if GDP is expected to grow 7%, the company will grow so much percent. In the market growth and market share approach, we first estimate the industry sales or the industry growth. The industry growth may again be linked to GDP growth or may be estimated by some other method, historical growth, etc. And we then estimate what will be the market share of our company within that industry. So if we expect the market share to increase, then the growth of our company will be higher than the growth of the industry. If we expect the market share to decrease, then the growth of our company will be lower than the growth of the industry. So in the market growth and market share approach, first estimate the industry growth, then estimate your market share, multiply the market share with the industry sales to get to the sales of your company and the sales growth. First is the growth relative to GDP, and second is market growth and market share approach, the two broad approaches suggested in the CFA curriculum. We may also want to understand if the company is enjoying any economies of scale. So companies that have good economies of scale will generally have lower costs and high operating margins as production volume increases. That is, there will be a play out of the operating leverage. So as production volume increases, fixed costs won't rise. The EBITDA will increase disproportionately, or the EBITDA margin will increase. For example, if $100 were my sales, $30 were my variable costs, and $30 were my fixed costs. If the sales grow by 20%, the variable costs will grow by 20%. However, the fixed costs will remain the same. In other words, the profit margin, which was earlier 40 divided by 100, that is 40%, will now become 54 divided by 120, that is equal to 45%. So as sales grow, earnings will grow disproportionately. For a sales growth of 20%, EBITDA is growing by 35%. So in companies that enjoy economies of scale, companies should exhibit positive correlation between sales volume growth and margin increase. As sales volume are increasing, the company's margins will also increase. Now, to forecast costs, we will take each cost item one by one. The cost of goods sold, or the raw material expenses, are the primary variable costs, and they will generally be modeled as a percentage of revenue. So we will see that historically the company has needed 30% of its sales. That is, we'll see the historical cost divided by the sales. That will give us the historical cost of materials as a percentage of revenues. So in the future, if sales are expected to be higher, then raw material costs will also be higher. So that's one basic method of forecasting the cost of goods sold. However, many a times you may need to adjust for individual raw materials, individual prices, if you have the data and if you see that there is a big impact because of the oil price or because of some other raw material whose cost has changed significantly. So expectations of changes in input prices can further be incorporated in this analysis to improve the projection of the cost of goods sold. Cost of goods sold, remember, are the raw material expenses. It will depend on sales, no doubt. As sales increase, more cost of materials, but it will also depend on the prices of the raw materials. And if there is decisive inflation or deflation, then we may want to include that in our projection. The sales, general and administrative expenses include expenses like advertising. Sometimes even employee costs are built in sales, general and administrative expenses. R&D expenses, repairs costs, maintenance costs, etc. are all part of SG&A. Commissions paid to distributors, commissions paid to agents will also be in this head. So corporate overheads, for example, electricity, security guards, CEO's salary, R&D expenses are generally stable, or they will increase only to the extent of inflation. The selling and distribution costs, that is advertising expenses or commissions paid to distributors, etc., go or will tend to increase with increases in sales. So a part of the SG&A will remain constant and will be easy to project. A part of the SG&A will grow in line with sales, so you will have to project it accordingly. Financing cost essentially is the cost of debt. So the primary determinants of the gross interest expense is the amount of debt and the rate of interest. Net debt is defined as the gross debt minus cash and short-term investments, also known as cash equivalents. So investments in government securities or liquid money market instruments are referred to as cash equivalents. So very important item that we track from the balance sheet is called the net debt, that is the gross debt, total debt minus the cash and cash equivalents. Net interest expense is the gross interest expense minus the interest income on the cash and these short-term debt securities that we own. We'll do an example and understand better the calculation of interest expense. Punjab Furniture has provided the following information. Gross debt in 2001, 2002 as well as the average is given. Cash and short-term securities are given. Net debt is given. Gross interest expense, interest income, whereas the net interest expense, that is the difference of the two, is calculated. Calculate Punjab Furniture's 2002 interest expense on average gross and average net debt and the yield on average cash balances. So the interest expense on average gross debt will be calculated as the gross interest expense divided by the average gross debt, that is 4,500. The interest expense on average net debt will be calculated as the net interest expense divided by the average net debt, that is 3,250. The yield on cash balances can be calculated as 300 divided by the average cash balance or the average cash and short-term security, that is 1,250. Which comes out to be 17.7%, 15.4% and 24%. So we forecasted revenues, we forecasted cost of goods sold, we forecasted sales, general and administrative expenses. Please note that depreciation can also similarly be forecasted by taking the firm's ending gross investment on the balance sheet, rather the net investment on the balance sheet, and then applying a suitable depreciation rate and calculating the depreciation expense for the current year. After depreciation, we projected the interest expense, and we now need to forecast the tax expense to reach to our net income and construct our pro forma statements. So the statutory tax rate is the applicable corporate tax rate. For example, 30% or 35%, whatever it may be. The effective tax rate is the actual income tax expense that the company shows divided by the profit before tax. This number can often be different from the statutory tax rate because of some tax benefits that the company may be receiving because of operating plants in backward areas or for certain manufacturing, etc., or various other provisions in the tax law that the company is exploiting, because of which its rate is higher or lower than the statutory tax rate. The cash tax rate is the actual cash tax paid divided by the profit before tax. So a lot of times there may be deferred tax assets, deferred tax liabilities, because of which the actual cash tax paid can be higher or lower than the reported income tax expense. So the cash tax paid upon PBT is referred to as the cash tax rate. Now, the expected effective tax rate is what we are interested in forecasting. We normally take help of the guidance of the management. We speak with the management to understand the tax regulations and the tax rates that are expected to be in the future. So we forecast the effective tax rate, multiply it with the forecasted PBT, which will give us a forecast for the income tax expense. Any change in the future effective tax rate must be included in your calculation and your analysis, especially when you see that your firm's tax rate is much lower than the statutory tax rate. Then it may want you to question the current tax rate and see if there is some benefit or there is some loophole in the regulation that the company is currently exploiting, which is likely to get plugged in the budget or which is likely to get plugged by the authorities soon, such that the tax rate will again come back to normal. Then again, future tax rate should be higher than the current effective tax rate, because that is what is expected to be. Just like we forecasted the income statement, a lot of times we are required to forecast the balance sheet. So Some items on the balance sheet, such as retained earnings, will flow directly from the income statement. So net income minus dividends will flow in as retained earnings. Other items like working capital, that is inventory, receivables, payables, are generally projected based on the historical turnover ratios. So historically, if the company had 12% of its sales as working capital, then as sales increase, even working capital will be expected to increase. If I gave credit to my customers on sales, then as my sales increase, my credit will also increase. So the working capital items, inventory, receivables, payables, are generally again projected as a percentage of revenues. Property, plant and equipment is determined by depreciation and capital expenditures. So if my plant is depreciating, then I know that I have to replenish to maintain my level of sales. So if I want to continue to have the same sales, or I want to continue to grow my sales, then I will need capital expenditures as my plants wear and tear, and as I need more capacity to grow more. Capital expenditure for maintenance should often be evaluated separately from the capital expenditure for new expansion or growth. So depreciation often is used as a proxy for the capex, or for the maintenance capex, or what the capex we need to do to maintain our business. However, please note that depreciation is based on the historical cost of the plant. The current cost may be much higher. So to this historical depreciation, you may need to add an inflation rate, because the current cost of setting up capacity, the same capacity, may be much higher when estimating the capital expenditure for maintenance, because replacement costs can be expected to increase. Please note guys, we are trying to predict the property, plant and equipment. Property, plant and equipment will increase to the extent I make investments in new plant and equipment. Investments in new plant and equipment will not just be equal to the depreciation happening. Even for maintenance of current sales, even for the maintenance, I may have to spend more than the depreciation, because prices today have inflated. The new depreciation expense obviously will be based on the new cost of acquisition. A very important calculation that is done when you are making new investments is the return on invested capital. Now, different analysts often have different ways of calculating the return on invested capital. Sometimes we calculate it as EBIT upon total assets. Some people calculate it as EBIT into 1 minus tax upon total assets. The advised calculation, or the advised formula for the ROIC, is the net operating earnings adjusted for taxes, that is EBIT, into 1 minus tax, since we are trying to again compute the return on our operating assets or the invested assets. So EBIT is the return that the asset has given us, but tax has to be paid. So EBIT into 1 minus tax, or NOPAT, is the return that we have gotten from the asset divided by the total value of the asset, or the total invested capital. Now please note what invested capital is. Invested capital is the net operating assets. So when calculating our operating assets, we exclude cash, because cash is not invested. Income from cash will be reported below EBIT. It will come in other income, just like interest expense. So what is an invested capital is my plant and machinery. My current assets or working capital can be a invested capital minus the current liabilities, not subtracting the debt. So plant and machinery, current assets minus current liabilities, that is net working capital investment, is what my operating assets are. EBIT into 1 minus tax is what these operating assets have delivered. So this is a very important metric that I will use before deciding whether the new investment should be made or not. If the new assets or the new investments are not generating sufficient EBIT or not generating sufficient return on invested capital, then they may not be a good investment. In fact, if ROIC is good, then of course by taking debt, by taking leverage, I can further enhance my returns. But that's the next step of calculation. ROIC is the return that the asset is giving. Firms with ROIC consistently higher than that of peer companies are likely exploiting some competitive advantage in the production and sale of their products. So, like we studied in private company, there may be some intangible, some brand value, some competitive edge that these companies have. Lower costs, better technology can all be reasons for a higher ROIC. What do we do, or how do we project our sales and costs when we know that there is inflation or deflation in the price of products as well as the price of raw materials? So increases in input costs or inflation in input costs will most likely increase the cost of goods sold unless the company has hedged the risk of input price increases by longing forwards or by entering into other futures for the raw material. So as even that will be normally a short-term contract. So normally when inflation happens, the input costs go up. There is nothing anybody can do about it. Only hope is that the price of the end product will also grow in line with the inflation such that your margins are protected. Vertically integrated companies are likely to be less affected by increasing input costs as against companies that are not integrated, because they will be procuring raw materials from outside, cost of which has gone up. Integrated companies have their own source of raw materials, so they will be less impacted. The effect on sales of increasing product prices to reflect these higher cost of goods sold, like we discussed, if COGS goes up, even product prices should go up. But this depends on the competition, the elasticity of demand, and the amount of competitors' price increases in the product. So your costs may be going up, but if your competitor is not increasing prices, you may not be able to pass on the cost increases. Or if the demand drastically falls, then again you may not be able to pass on the price increases. So let's understand the effect of price inflation on gross profits, gross margins, and operating margins. Michael Incorporated sells television components. The firm's income statement for the past 1 year is given below. So revenue is $400,000. Cost of goods sold is $120,000. The gross profit, SG&A, and operating profit is given. In 2012, the input cost will increase by $10 per unit. So from 60, this will become $70 per unit. Calculate the gross margin and operating margin for Michael for 2011. Calculate the 2012 gross margin and operating margin, assuming that the entire increase in input cost is passed on to customers through an equal increase in selling price. The number of units sold is not affected. So for 2011, the gross margin is quite easy. It's 280 divided by 400, and the operating margin would be 200 divided by 400, and that is 50% and 70%. For 2012, option A says that the entire increase in input cost is passed on to customers through an equal increase in selling price. So the COGS became 70, the revenue also became 210. So the revenue in 2012 under option A will be $420,000. The COGS would be $140,000. The gross profit would be equal to $280,000. The gross margin now will be 280 divided by 420, and the operating profit will continue to remain $200,000. The operating margin, however, will become 200 divided by 420. So the operating margin comes down to 47.62% and the gross margin comes down to 66.67%. Even though absolute profits are the same, the sales have increased, bringing down the margins. Selling price is increased by 10% and the number of units sold decreases by 10%. So that's another thing that the company has to be careful about. If it raises the price too much, it may have an impact on demand. So in option B, the revenue would be 1800 multiplied by 220 because the price has been increased by 10% and the volumes decreased by 10%. That is $396,000. The cost of goods sold would be 1800 into 70. That is the new price. That is $126,000. The gross profit would be the difference of the two, that is $270,000. The SG&A will remain at 80,000, giving us an operating profit of $190,000. So raising the price by 10% doesn't seem to be a very good move. Even though margins may look okay or may not depress as much, but we see that the gross profit as well as the operating profit in absolute terms has come down. Similarly, we can do the calculation when number of units sold decreases by 40%, it will be an even more detrimental situation for the company. This was case A, 66.7 and 47.6. Case B, the margin is slightly better than case A, but in absolute terms, it is not better. Case C, again the operating margin takes a further hit because volumes go down drastically. In today's world, we often see that technology of production and technological developments have a big impact on the firm's profitability and the firm's process of production. So what we can say is that some advances in technology definitely decrease the costs of production, which increase profit margins, at least for early adopters. If everybody has adopted that new technology and the price has come down, then profitability may not increase. But at least for the early adopters where price hasn't fallen, but the new technology has reduced the cost of production, there will be a benefit. Other advances in technology will result in improved substitutes or wholly new products, which may at times be to the detriment of the existing industry or the existing companies. One way for an analyst to manage or to include the introduction of a new substitute is to estimate a cannibalization factor. That is the percentage of the existing sales that will be taken up by the new substitute. So if new substitutes are coming because of the new technology, then there may be some cannibalization that may need to be estimated. Now the question asked is that what should be our forecast horizon, or to what extent should we explicitly project the pro forma financials, that is individually model each income statement item and each balance sheet item, and from what point on should we just give a terminal growth assumption. Now, on the explicit forecast horizon, it is generally recommended that it should at least be as much as the expected holding period for the stock. So if you're expecting to hold it for 3 years or 4 years, then at least 3 years or 4 years of earnings you should understand very well, or you should forecast explicitly, and after that you can have some terminal growth assumption. For cyclical companies, it is advised that you at least take one cycle, that is good times and bad times, otherwise you may not fully understand the profitability and the forecasts for the company. So evaluating through the entire cycle will help analysts forecast the normalized earnings, that is the expected earnings over a period of time. There can be periods of very high growth, there can be periods of very low growth or very low earnings, or even profit declines or losses. But on an average, what is the earnings that the company has been able to generate over the cycle is what we are interested in, because cycle after cycle, that is what is expected to repeat. So when there have been impactful events like acquisitions, mergers, restructurings, then these events should be considered temporary, and any legal expenses or one-time fees or one-time expenses that are there should be negated. So the forecast horizon should be long enough such that the perceived benefits or synergies can be seen in the income statement, so that you understand or you get a better sense of the long-term cash flows and the long-term profits of the company before you apply a terminal assumption. So you would want to reach the stable state before you apply a terminal growth assumption. Finally, a lot of times it may be the case that the forecast horizon is dictated by the company policies or the analyst's manager, so he has to forecast to the extent that the fund manager or his boss wants. Now, beyond the short-term forecast horizon, so for some period we have explicitly forecasted and projected the earnings. Beyond that period, we may need to make a terminal growth assumption, because company is a going concern, so that value cannot be ignored. Just because we haven't forecasted it doesn't mean it doesn't exist. So earnings projection beyond the short term are often based on the historical average growth rate or the previous economic cycle, or the GDP growth, or some long-term sustainable growth rate that we can estimate. An analyst will typically estimate a terminal value at the end of the forecast horizon using either a price multiple or a discounted cash flow approach. Using a PE multiple, the earnings in the final forecast period are multiplied by this historical average PE or some terminal PE that you want to assign. Using a discounted cash flow approach, you can apply the Gordon growth model and do a D1 upon KE minus G, where G is the perpetual growth rate assumed. You must, however, be aware that the value of the company can significantly be affected by the assumptions that you make. So a slight increase or decrease in this growth rate assumption can have major implications for the stock and for your recommendation. So as far as possible, you should try to project to whatever extent you reasonably can, and then apply a sustainable growth rate assumption. Problem in this analysis comes because of the presence of inflection points. So inflection points are points where the company's growth rate materially changes. From a low growth it becomes a high growth, or from a high growth it becomes a low growth company. So these inflection changes can happen for many reasons: technological factors, economic factors, GDP growth, etc. They will often be very difficult to call, and they can cause errors or mistakes in the forecasts. Finally, with the understanding of all the factors that we studied, we will be able to project a pro forma company model, that is a pro forma income statement, balance sheet and cash flow statement. So first, estimate the revenue growth and the expected revenue. As a percentage of the revenue would normally be the cost of goods sold. Forecast the SG&A and the financing costs and the tax expense as we just discussed. Model the balance sheet on the items that flow from the income statement, and the estimates for the important working capital accounts that will normally be a percentage of the sales. So retained earnings will come from the income statement. The current assets minus current liabilities, etc. will be from the sales or some percentage of the sales. Use historical depreciation and capital expenditures to estimate future capital expenditures and net property and plant and equipment for the balance sheet. So similar process should be repeated for 2, 3, 5 years so that you're able to estimate a pro forma company model. Once you have the income statement and the balance sheet, you can use either the direct method or the indirect method to calculate the cash flow from operations, and similarly the cash flow from investing, the cash flow from financing, and the total cash flows. We studied in financial statement analysis at level 1 how to create a pro forma company model. Please watch that video again if you want to have a detailed sense of how we can do this with the example of a company. At Finstructor, we took the example of an automobile company and we projected the earnings, cash flows, and the balance sheet of that automobile company. So the broad steps followed are exactly similar to what we have studied. So that's about the review on industry and company analysis. Again, a very complicated exercise in the real world. So this is what an analyst's job is, or this is what most of the people working in the finance industry will do. However, for the exam, it will be a relatively easy topic because with 3 choices available on the level 2 exam, I don't think there should be much trouble getting onto the right answer. But please make sure you revise the review once again and you go through the topics. Nothing as such is very difficult to understand.